Bloomberg Commodities Edge. Let's turn now to Commodity in Chief, where we focus on one executive in the commodity world. And today, it's Wally Kandel, founder of Shell Crescent USA. First, let's take a closer look at the company. The number, $188 billion, the amount of money poured into the chemical industry in the U.S. Gulf Coast since the shale gas revolution started. Now, Appalachia wants a piece of the action. Here's how it works. A petrochem plant takes wet gas like ethane, takes it apart, and puts it back together as ethylene. Then that gas is transformed into polyethylene, which makes plastic. The pitch? The Shell Crescent. It's the home of wet gas from the Utica and Marcellus, and the region should supply 37% of the U.S. natural gas production by 2040. Input costs are cheaper, and 2/3 of U.S. demand is local. So far, only Shell is biting. Other companies like Exxon and Dow are sticking with the U.S. Gulf Coast. It's got exportability, transportation, and storage. The U.S. Gulf Coast has wooed more than 70% of the capital spend. What can the Shell Crescent do? Well, I recently caught up with Wally Kandel, founder of Shell Crescent USA.
The region of Shell Crescent USA is really along the Ohio River on the borders of Pennsylvania, Ohio, and West Virginia. And the advantages is if you go back to 2010, the amount of natural gas that was being produced in this region was about 3%. Today it's 30%, and if we look out at 2040, it's 37%. A lot of that gas has natural gas liquids with it, which is the feedstock that's needed for petrochemical industry.
Why Utica Marcellus trumps Haynesville and, say, Permian associated gas for Shell Crescent?
Well, I think all of those are going to be important things for the growth of the petrochemical industry in the U.S. But the location of the markets and the proximity to the natural gas is really a big piece here. In Shell Crescent USA, you have the most abundant natural gas, the cheapest natural gas in the developed world. You have a very plentiful water supply from the Ohio River, and you have within a day's drive 70% of the market. So if you're looking at an polyethylene plant, the people that consume the polyethylene pellets, 70% of those in North America are located very close to Shell Crescent USA. So you basically save the transportation of the gas from the Marcellus and Utica down to the Gulf Coast and the transportation cost of the pellets to bring it back.
If you wind up having lower input costs, are you also making less for the products that you sell?
Well, with lower input costs, the pricing is basically a regionalized pricing. So you can deliver the polyethylene price, or the polyethylene 23% lower if you're producing it in Shell Crescent USA. That gives the opportunity for the polyethylene producers, one, to take a big piece of that, but also to provide some savings for the converters who are taking those pellets and making them into products.
So companies like Dow and Exxon have really stuck to the U.S. Gulf Coast, in part because they say transportation, truck or rail, it's also easy to get their product out in terms of exporting and their storage. What do you make of that?
Okay, so first off, for the last 75 years, the right place to put a petrochemical plant in North America was on the Gulf Coast. But with the change in where all the energy is coming, that situation has changed. So if companies have big assets that are already located on the Gulf Coast, the savings is probably not enough to entice them to build another facility. But if I'm a foreign company wanting to play, so to speak, in the North American petrochemical market, and you're looking over here, I mean, North America has the cheapest energy in the world right now, and when you look inside of North America, Shell Crescent USA is the best place to invest. So I think those are the most likely companies. You know, we see Shell that is invested in Beaver County, Pennsylvania. PTT is hopefully close to announcing that they will be building a polyethylene plant in Belmont County in Ohio. And based on the study, there's room for 3 or 4 more.
So how much does it cost to build a plant?
Well, the estimates for the plants that are going in right now are somewhere between $3 and $6 billion. I know that's a big range, but it really depends on the size of the plant that they build.
Over time, how much can a plant return in the Shell Crescent versus the U.S. Gulf Coast?
Well, when we looked at the economics of building the same facility, we chose a $3 billion facility that could be built in Shell Crescent USA and on the Gulf Coast. And the net present value is 4 times higher in Shell Crescent USA because of the savings in the feedstock and the transportation savings.
Wally also told me he's convinced that the distance from the Permian and the U.S. Gulf Coast will be the key factor in luring those petrochem plants to Appalachia. All right, now here's what's on my radar. Strikes in Brazil. The country has been crippled by a trucker strike to protest higher diesel prices, and that has stopped deliveries and blocked roads. Joining me now is Peter Millard, Bloomberg's Rio de Janeiro bureau chief, who's joining us from there. Peter, what's the status of the union strikes?
Thanks for having me on your show. The strike is starting to wind down. The government has managed to lift most of the road blockades around the country. However, the all-important commodities exports are still being affected. The big export terminal in Santos and Sao Paulo state, while there are no more blockades, the military is still there to disperse protesters and guarantee access in and out of the port. And so some of those exports have been some of the slowest things to come back to normal here in the country.
Yeah, Peter, and if we drill down, say, just to soybean exports were already rolling over before this. So you answered kind of my question is, how quickly can the system, in particular, say, with soybean exports, so important to Brazil, be up and running? What's the difficulties?
Yeah, right now we do still have delays in loading at a lot of the terminals. We still have a lot of delays in getting the crops to the terminals. The good news is that there haven't been major crop losses. The crops have still been harvested. The harvesting has been a little bit slower, and so the product will eventually get to market. And so a lot of the analysts are saying that the impact on prices could be somewhat short-lived.
And Peter, at the center of this is Petrobras and CEO Pedro Parente, who wound up raising diesel prices that sort of triggered the strike and then since cut them. Is Petrobras the scapegoat here?
Yes, that's right. A lot of the politicians in the country are targeting Petrobras in particular for taking on a market-based pricing policy, which on one hand helped deliver the best quarterly results in about 5 years during the first quarter of this year because they were able to take advantage of rising oil prices globally, and now that has also turned around and caused protests in Brazil, which is a country historically we're used to having fuel prices, particularly diesel, subsidized and shielded during these price booms, and so that really triggered protests.
Peter, I'm sorry, we have to leave it there, but thank you very much. Peter Millard, Bloomberg's Rio de Janeiro bureau chief. That does it for Bloomberg Commodities Edge.
York City for our viewers worldwide. I'm Jonathan Ferro with 30 minutes dedicated to fixed income. This is Bloomberg Real Yield. Coming up, a blowout jobs report leaving the Federal Reserve on track to deliver more hikes this year. Political risk in Italy reminding bond investors that liquidity might not be there when it's needed most. And a tough week for a former bond king. Bill Gross tells us why his fund had its biggest one-day drop in 4 years. We begin with a big issue, a blowout jobs report.
The numbers are strong.
It's good news or positive news on all fronts.
It's a good, solid gain in the labor market.
I think the wage number was very important, and this is good news on the wage front as well.
Even though wages are up to 2.5% or just above 2.5%, it's still not strong, right? Inflation is bouncing around too, so real wage growth really is pretty muted. So people are dipping into their savings to continue to spend, and that's worrisome.
The 2.7% welcome news, but still not 3% sustained. We're still not seeing that real acceleration, broad-based acceleration in wage growth that we'd like to see out there.
It's pretty much of a scenario where the Fed hawks basically think that they can move forward once, twice. Some say 3 times. I say June is the last.
The numbers are strong now. I do think as you get into next year, it's going to be a difference. So when you think about, is the Fed going to go 3 to 4 times this year in total? They're going to go 3 to 4 times, probably 4 times. How much they go next year, I think, is a question.
Joining me around the table in New York is Robert Tipp, Chief Investment Strategist at PGIM Fixed Income, Mary Bowers, Senior Portfolio Manager at HSBC Global Asset Management, and Bob Miller, Head of US Multi-Sector Fixed Income Strategy at BlackRock, joins me around the table as well. Guys, it's great to have you with me. Bob, I want to begin with you. It's very hard to find any weakness in this jobs report today. Did you find any?
I'm sure if you looked hard enough, you could find something to be disappointed with, but it's a really solid report. Labor market's in a great place. It's going to continue, in our judgment, it's going to continue to grow, albeit not at the pace that it's been growing for the last couple of years. Unemployment rate's likely headed toward 3.5, maybe a touch below, and wages are going to modestly move a bit higher.
Mary, in a week that people have tried to poke holes in the macro backdrop, trade, things in Europe happening, actually things in the United States look pretty decent, and the data seems to back that up. Is that what you see too?
Well, for high yield, and you wouldn't think of high yield as being a safe haven, but U.S. high yield relative to other regions this year has held in really well.
Yeah, triple C's more so.
Triple C's more so, which again, what's been the problem for high yield? It's really been rates. So when we get a jobs number like today, certainly it does keep us cautious on the duration side and keep us still liking the triple C and single B part of the market.
And Robert Tipp, just in terms of rates, it's been a strange week where some people started to remove rate hikes for 2018. Did that make sense? Does it still make sense?
Well, you know, we saw back in 2015 that when you had that crisis and the Chinese currency was on the brink of devaluation, having sharp moves, that the Fed basically moved to the sidelines. We saw that early this year in January when there was stress in the market and the big volatility spike, people began to price the Fed out. So I think, you know, that is correct of the market to figure that the Fed may get dragged into this because Italy is a big country. The European project is, you know, basically 20 years old. They're celebrating their 20th anniversary at the ECB. And it could be a systemic shock. So that makes sense. But having said that, as soon as you get past the peak of that crisis, then you begin to go back to pricing and the realities, the fundamentals on the ground, which are good.
The fundamentals are good. So why do we have this spread that's so big, Bob? And we can bring up the dot plot for the Federal Reserve against the market. We got used to this a couple of years ago, but then more recently things narrowed. Now they've blown out again, where you've got this 100 basis point spread now pretty much in 2020. Now I know 2020 is ages away, but it just gives you an indication that this market doesn't quite believe the Federal Reserve can go where it's projecting it's going to go. Where's BlackRock in between those lines?
We think the Fed's moving, as my colleague, you appropriately showed the clip earlier. My colleague Rick Reeder said we think the Fed's going to move 3 or 4 times this year total, so June and then September and probably December. But we don't think they're going much above, at least for the time being, much above 2.5. And to be fair, the market's, as you just pointed out, the market's priced for a 2.5% terminal rate, 260, something like that. The gap in the dots, remember the market is, I know you know this, the market is a probability probability-weighted pricing mechanism. So it includes some probability of higher rates and some probability of lower rates. And the long-term neutral rate in this country is under debate. There's a fiscal policy impulse that's just now kicking in, likely to impact growth and inflation for the next several quarters. But in the overall medium term, with the demographic trends and the technological innovation impacting inflation, we don't think rates are going as high as the dot plot suggests.
Do you agree with that as well, Robert?
Well, our base case sees them going higher, that they're going to have the scope to continue, the economy's good, and they'll continue. But I agree that once they get to what they perceive to be as neutral, that the onus on them, the burden of proof, is going to really rise for continuing to raise rates. Because you're in a world where, although, here in the U.S. people are thinking, 2, 3, these are not high interest rates, but you look around the world, rates are really low. You're looking at a 5 basis point JGB. We had bonds, after being as high as 65 basis points, we're down at 20 a few days ago. That's at the 10-year point. Yeah. So we're in a really low interest rate world, and I think they'll probably get some signals that'll slow them down. Again, once you get to that 2.5 area.
And negative all the way out to 6 years in the Bunn curve as well, and we can talk about that a little bit later. Mary, this concept of the Federal Reserve of gradually moving through neutral. Governor Brainerd discussed it this week, moving through neutral. How key is it for the Federal Reserve to get to a place where it can move through neutral? And what would that mean for risk assets in the United States at a time when actually for a long time now we've had very accommodative Federal Reserve policy?
I mean, it's certainly interesting, and as we have seen the Fed start to move for high yield, this year so far, we've seen a good amount of outflows from the asset class. Now, all that being said, spreads have been fairly stable, but certainly as rates rise, some of the more levered issuers in our market could see some headwinds in terms of the cost of debt.
I saw a commentary, a piece from a professor of the University of Oregon on Twitter, actually, Bob, and it was really interesting. He pointed out this tension in the market. The Federal Reserve is talking about moving through neutral. The market doesn't really buy it because the market sees the Federal Reserve as very nervous about inverting the yield curve and believes that if the Fed wants to ultimately go through neutral, they're going to have to invert the curve and don't want to do it. Can you reconcile those two things? Can the Federal Reserve get away with getting through neutral without inverting the yield curve?
It's possible. It depends. I would think one of the important factors that will influence that outcome is out of the Fed's control, which is Treasury issuance. Yeah. And how does the Treasury manage the growing deficit financing needs that they have over the next several years? So far, they haven't extended the duration of the weighted average maturity, and they're probably unlikely to do so in the near term, but a shift in issuance technicals could easily help the Fed avoid an inverted curve, even if they're moving above their version or their assumption of neutral.
Just to take stock, as we close out this segment, Robert, every single Friday, if you just sort of went on vacation over the last couple of months and only checked in on the market on a Friday, you'd think nothing would happen at all over the last few weeks on a 2-year, and hardly much has happened really on a 10-year either. This Treasury curve has suddenly started to stabilize in quite tight ranges, and I know we've had a pretty vicious week, but when you look at the 2-year, every single Friday over the last, say, 5 Fridays, it's in and around 250. What is the signal you take from that?
Well, there are a couple of things. The one directly is that, the underlying fundamentals of growth and inflation, despite everybody's anxiety, are pretty stable. It's a good environment, and the Fed has been largely on their game, but by historical standards, they're being very cautious. And so I think that's why the big, the ultimate change that you're seeing, not the intraday, but often is quite muted. I will point out, though, that to Bob's point about Treasury issuance, Treasuries are wide relative to the internals of the Fed funds market. And in fact, the Fed funds swaps beyond the 10-year point are already inverted. They're only at 2.5%. And I think the focus may change as the Fed funds rate gets higher. People realize, those expectations are inverting.
Let's continue the conversation. Robert Tipp sticking with me from PGIM Fixed Income, and Mary Bowers from HSBC Global Asset Management alongside Bob Miller from BlackRock. Coming up, the auction block, Italy bringing some relief to jittery markets following this week's meltdown in the nation's bonds. This is Bloomberg Real Yield. Jonathan Ferro. This is a Bloomberg Real Yield. I want to head to the auction block now, where Italian bonds have got a little bit of relief through the week. The country sold 3.6 billion euros of 5 and 10-year debt, with both auctions oversubscribed by investors. Average yields, though, were substantially higher than at last month's auction. The nervousness surrounding politics showed up across Europe this week, including in Poland, where they may scrap its only regular bond auction plan for June, leaving its calendar blank for the first time this year. And in European corporates, only 82 billion euros of bonds were sold across May, a decline of nearly 50% versus a year earlier. Just a handful of investment-grade issuers braved Europe's debt markets this week, posting the slowest week for sales this year. Still with me, Robert Hitt from PGIM Fixed Income, Mary Bowers from HSBC Global Asset Management, and Bob Miller from BlackRock. Bob, let's get your thoughts. The takeaway from Europe this week, just wow. The lack of liquidity just evaporating like this. What's the lesson we learned from this week?
So I think there are a couple of things. One is, at a very broad level, the markets are much less forgiving this year relative to past years, and you've mentioned this before in some other on this show. This notion of the 6-year very aggressive monetary policy accommodation that provided a tailwind for all of financial assets. That's changing. It's changing the most in the U.S., but it's changing globally to one degree or another. So markets are just less forgiving than they have been, and I don't think that's going to change anytime soon. Specifically with respect to Italy and the European situation, I think it highlights the degree to which that market is based upon very aggressive. Bond market valuations are primarily a function of very aggressive monetary policy intervention, unconventional policy pursuits. And when there's a question about whether or not the central bank can or will continue to support a particular market, the difference between fair value with intervention and fair value without intervention is a really big number.
Robert Hitt, did you try and get involved in some of the price action on Tuesday when we saw the market just gap ridiculously lower in Italy?
Well, I mean, there are definitely opportunities there, because I think as unstable as the situation as in Italy has been, that Europe is really in a very strong footing. I mean, compared to 2012, 2013, 2011, they've taken phenomenal steps to really strengthen their system, and a lot of those countries are reaping the benefits. So growth is strong. The ECB is in a good place if they needed to support them, but the Italians have to be in line. They have to stay with the program, and that was definitely in doubt. But with all of the countries seeing their spreads widen, Portugal, Spain, there are definitely opportunities there, even France.
Mary, liquidity totally evaporated in one of the biggest bond markets on the planet, and I wonder what the lesson should be for anyone in high yield. There has always been this sense that you can get out when you need to get out, but the fact of the matter is when you need to get out most, you can't. Do you apply any of the lessons that we could have learned in the Italian bond market this week to your world, to high yield?
You know, I think, to be quite honest, it's something that we think about a lot for many years. I mean, we saw that during the kind of mini energy crisis in high yield a few years ago, and that's certainly not lost on us. So it's something that, you know, we keep in mind in all of our portfolios.
It was a difficult week as well for Bill Gross, the former bond king, of course, having one of its worst days in his fund over at Janus Henderson since its inception over the last 4 years. I actually caught up with Bill Gross and asked him just what went wrong this week in terms of the strategy. Take a listen to what he had to say.
Demonstration of Wirecast.
The strategy, basically, which was the basis of your question, has been a strategy that has been short the German Bund and long U.S. Treasuries. You know, the spread between the two is historically high. For instance, on the 10-year U.S. Treasury versus the 10-year Bund, it's 250 basis points. It's never been at that level.
That was Bill Gross catching up with me a little bit earlier. Bob Miller just raised the question, if you're expecting that spread to narrow and you want to do it by shorting bunds and going long treasuries, how difficult is it to be short bunds? Because we still have an incredibly distorted market in Europe. We have an inflation print just south of 2%, yet bunds are still negative out to 6 years. Can you short bunds? And is it just a widow trade all over again?
Well, you can short them for sure. Whether or not you're going to reap a profit is a very different question. I go back to the prior comment, and to echo what you just said, the market doesn't, German bonds don't trade at valuations that have anything to do with German economic fundamentals, the trajectory of growth or inflation. It is a function of negative short-term interest rates set by the ECB and overwhelming intervention through large-scale asset purchase programs. Yes, they're running now less than they were a year ago, and they're expected to taper toward zero. Our expectation is the ECB will have a very difficult time exiting large-scale asset purchase programs over the next 3 to 6 months, even though they may very well dial it down going into 2019. But those markets, they're not free to trade based upon economic fundamentals. So it makes very challenging a relative value trade against a market that is less influenced by the central bank intervention.
Robert Hibb, your thoughts on that and the idea that maybe we do have the Widowmaker all over again, except it's not Japanese and this time it's German.
Right. Well, the problem is that there is the ECB in the market, but there's a huge captive buyer base that has to stay at the top end of the Treasury markets. And, you know, they can look at all of these different markets on a hedged basis. And when they're looking at JGBs at a 5 basis point yield, in Germany, you know, when the bonds are up at 0.5%, your financing is way below zero, and there's actually a decent amount of carry, and there's a small amount of negative supply in bonds. So these things are like a gold commodity, and so to go and short them is obviously very dangerous, despite the fact that by some measures the yields are low and they may look expensive.
That spread got out to about 320, 2 years, bonds versus treasuries. Can it stay that wide? I mean, I spent so much time asking that question. Do you think it can stay that wide?
It's going to go, I mean, the chances of it going wider have got to be like 50-50.
Really?
Because, I mean, the Fed is going to be marching along, presumably another 50, 100, 150 basis points, and twos are going to have to go with a lot of that movement. By the same token, the ECB is probably going to be stuck, you know, trying to get to zero for 2 years. And so that spread is going to be under pressure, and all the while, Germany's probably a slight surplus, so there's absolutely no supply, and on the Treasury side of it, massive amount of Treasury issuance. So I think there's going to be pressure there.
Mary, it's a pretty crude way of capturing the transatlantic divide, the European economy versus the US economy, but I guess there aren't many better ways of doing it than just comparing where bonds are to comparing where Treasuries are. Does Buy America ring true with you at the moment? Is that where people should be adding exposure to risk assets?
It feels like for now, yes, the U.S. high yield has held in quite well, as I mentioned. In European high yield, we have been underweight this year, and we have been wrong for some time on European high yield. So earlier this week, as the iTraxx did widen on Italy, we did take some of that protection off because, as you mentioned, you know, away from Italy, European fundamentals still look pretty healthy. That being said, for the U.S., we're not jumping up and down about high yield at these levels, and certainly recognize that, you know, if things were to get worse in Europe, we could see spreads widen. But for now, it still feels like we're pretty insulated.
Mary Bowers from HSBC Asset Management, sticking with me alongside Robert Hibb from PGIM Fixed Income and Bob Miller from BlackRock. Next up on the programme, we're going to bring you a market check on where bonds have been this week. 2s, 10s and 30s yields, believe it or not, after the week we've had, down just a basis point on a 2-year, and on a 10-year note, we are down by about 4 basis points to just south of 290. Still ahead on the programme, the final spread, the week ahead featuring the G7 summit as trade tensions spread around the world. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is a Bloomberg